Homes Today will now paint the screen of women's worldview. Hostess, beautiful Miss Audrey Forshey, a well-recognized realtor and an advisor at Remax Realty. Her guest on the set is Mr. Barry Filderman, who is a senior loan officer. Today, they will educate us on conventional loans. Let's take a look.
Hello viewers, welcome to Homes Today. I'm Audrey Forshey from Remax Realty Services in Rockville, Maryland. And again, to talk about loans and mortgages, I have our friend Barry Filderman from George Mason Mortgage, and he's going to come and talk about conventional loans today. And we're going to talk about what the difference between conventional loan is versus an FHA loan, which we've spoken about before, and maybe if this is a kind of a loan that is good for you, or maybe you'd go back to thinking that the FHA loan is better for you. So we want to give you all of your options and let you know what you can look for in a loan and the kind of questions you should ask your loan officer when you're applying for a mortgage today. So the first question I have for you, hi Barry, thanks for coming again. What is a conventional loan? Why is it different than an FHA loan?
A conventional loan is basically any loan that's not FHA or VA or any government loan. I think a better way of putting it, where most people run across, is what the difference between conforming conventional and non-conforming conventional. Conforming basically means that it conforms to Fannie Mae and Freddie Mac guidelines. And a lot of people will understand that by the 417, like it has to be within the 417,000 range. That's a conforming loan. Now certain counties allow that to be extended, so you have a conforming jumbo loan that is still sold to Fannie Mae and Freddie Mac depending on the county, and that goes up to 625.
Okay.
And one of the nice things now is they just raised that 625 to where you can put less down. So you can get a bigger loan up to 625. It only requires 5% down. It used to be 10. So that'll help people.
Okay. And so if I'm a conforming loan or if I'm a non-conforming loan, I understand that it's 417 or less, or depending on where you are, it's 625 or less. And then anything above those numbers is then called non-conforming.
Right.
So what does that mean to a borrower?
Anything that is not sold to Fannie Mae and Freddie Mac is a non-conforming because it doesn't conform to Fannie and Freddie guidelines. And this is the scary part, is that every one of these non-conforming investors has different rules. It's kind of easy to know what Fannie's rules are and Freddie's rules are, but on a non-conforming, you could have 7 different investors and every one of them has 7 different rules for things like assets and income and what they'll allow, reserves, things like that. So you got to know what you're putting into each product.
So Fannie Mae and Freddie Mac have their own set guidelines, and you have to just be able to follow those guidelines. And then the non-conforming, so if you're doing a non-conforming loan, does that mean you're going as a lender? Do you go, who are the investors? Where do you find these investors? Are they big banks, or are they, where does that money come from?
Most of them are big banks.
They are?
And unfortunately, the companies, they have people that do nothing but to try to find jumbo money to help the loan officers originate and be competitive. But you'd be surprised how different each investor is. I'll give you just an example.
Okay.
Some non-conforming investors do not count the paying off of a junior lien, a second mortgage,
okay,
as being a cash out. Now Fannie and Freddie, if you're paying off a second mortgage, and it's not a second mortgage that was taken out originally when you bought the house, it's considered cash out.
Okay.
So some jumbo investors, they don't consider that cash out, or they might require 12-month seasoning. So with the rates being so low and a lot of people refinancing, that's the difference between a full point, is a cash out refi compared to a no cash out refi. So if you don't know your guidelines, you might be charging your customer more than you have to by putting it into with an investor that doesn't consider that as cash out.
And so seasoning means that you've put money into one of your accounts, like a checking or a savings account, and it's been in there for a while. Is that what seasoning means?
So that's seasoning of assets.
Okay.
But when you're talking about seasoning of a second loan,
okay,
some investors will say you cannot have withdrawn anything from that home equity loan for 12 months.
I see.
Some are 24 months, some are not at all. So you got to know.
Okay. And as a real estate agent, I usually think when I'm writing a contract for one of my clients, I feel like I want them to go with a conventional loan because I feel like maybe that shows that they're a stronger buyer. But you know, sometimes people don't have the cash to do a conventional, you know, a 20% down conventional loan. There are, like you said, a 5%, you could do 10, 15%. And do you feel like a conventional buyer is a stronger buyer than maybe other kind of loans? Do you think it's better for people to try to get a conventional loan?
Well, in some cases, and I think that's a generic attitude, and it's not true.
Okay.
One given example, that customer would be a stronger buyer if they went with an FHA loan. In other situations, it's much better to go with a conventional loan. So I don't think it's a good idea to categorize it that a conventional loan means that the buyer is stronger. Now, most of the time when someone has really good credit, you're going to go conventionally. And that's a topic for another thing, because there's mortgage insurance, there's down payment requirements, there's things like that that make it so much better to go conventional than to do an FHA type of loan.
Okay.
But for the time being, conventional, they have 3% down programs, they have 5% down programs, they have 10%, and of course the 20% or more.
And so if you put less than 20% down, you're going to have mortgage insurance attached to your mortgage. So what kind of a structure is it? Is it based on the percentage you put down, or is it a flat fee? How much is the mortgage insurance typically on if you put less than 20% down, or do you have to calculate all the different nuances in terms of credit and all that sort of stuff?
Well, it depends on two things. It depends on how much money you're putting down, and it depends on your credit scores.
Okay.
The higher your scores, the lower the insurance.
Okay.
The higher your down payment, the more the insurance is going to cost. There's different types of insurances, and again, we can get into that in another topic. But right now, when you're putting 3% down, you're putting 5% down, the insurance is going to be much higher. And this is why I said that a lot of times, if your credit score is under 700, it's probably better to go FHA. It's cheaper.
Okay.
It's cheaper. The conventional loans really give you a little more flexibility when it comes to getting rid of the mortgage insurance, because FHA you can't. So the coverage also, when you're putting 5% down, the lender has more risk, so they're going to require more insurance, so it's going to be more expensive. If you're putting 10% down, there's less risk because there's some equity, and again, only putting 15% down, it's also you can get rid of the mortgage insurance on a conventional loan, where FHA, it's not so easy.
So I've heard people say, you know, they want to do conventional because once they get the 20% or 25% equity in their house, that the mortgage insurance goes away. It just doesn't fall off. You have to refinance the house. Don't you have to do a refinance, or do you apply for the mortgage insurance to go away? How does that work?
Well, it works basically on the principal remaining in the appraised value, so it could fall off after a certain time. But most people are pretty savvy, and if their values of the houses go up, they know about it. If they've paid equity into the house for a few years, they know about it. And then most people have a real estate agent that they keep in touch with, and most of the time you're going to want to either refinance that house and get rid of the mortgage insurance, or if you have enough equity and the house has gone up and up, you want to send an appraisal to your company, call up whoever's servicing the loan, and make arrangements to try to have that mortgage insurance removed on its own.
Okay, very good. So the benefits we just talked about, maybe that it might be easier for you to do that, or you might get a better rate on some of the conventional loans. So let's just talk about, what are the hard things about a conventional loan? What are the negatives about a conventional loan?
Well, the negatives about a conventional loan, really, most of the negatives that come into play when you're putting very little down.
Okay.
If you're putting 3% down, there's a lot of rules and regulations, credit score requirements, income requirements, household, number of people in the household. The mortgage insurance is much higher on these types of loans.
Okay.
And in many, many cases, an FHA loan is the best way to go. And sometimes people just throw themselves into these programs, and it's really not the right one for them. The more you put down, the better it really starts getting into. Once you get into 10% or more down, there's so many more options to save money, and that's what's good. Conventionally is, again, a little stricter in underwriting in certain scenarios. And in certain scenarios, because they've changed things, they're actually easier now than FHA. I could have honestly said a little bit ago that every part of an FHA loan is easier than a conventional loan, but I can't say that anymore.
Because all of the changes.
Yes.
So if I'm going to have a conventional loan and I'm going to apply for it, am I worried about things like, can I be a self-employed person? Can I get a loan? What are my rules for, I am a self-employed person, so what happens to me when I go make an application to get a mortgage on a house? What do I need to look for and do?
Again, that is an excellent question. I'm glad you brought it up because a lot of people out there are self-employed. A lot of people are commissioned. Real estate agents that work as an independent contractor, as well as a lot of insurance agents, are considered self-employed because they put their income on that Schedule C. Conventional, and here's one of the things that people don't know. I can't tell you how many loans I get approved because the loan officers don't know the difference between Fannie Mae guidelines and Freddie Mac guidelines. Fannie Mae guidelines and Freddie Mac, everyone thinks they're the same, and they're not. They have different rules and they have different requirements. Now, as far as being self-employed, you have to be 2 years self-employed.
Okay.
Some cases there are exceptions, but let's for argument's sake, let's say 2 years. But Freddie Mac only requires 1 year of tax return. So all you self-employed people out there that started up 2 years ago that had that expense of starting up and your income might be lower, I don't have to use 2 years of tax returns. I just need the 1 year. Most loan officers, and I don't want to say that, some loan officers will generically ask for 2 years and you don't need it. And this really qualifies people when a lot of times they're told, no, I'll get the file and I'll kind of like, thank you, and I'll take the loan and get it through.
And fix it and get it through. So, and then if you're a regular employed person, that's probably easier. What about, I always wondered about people that are retired. Let's say they're on a fixed income. Do conventional loans, do they look at that? Is that okay? They can just use their Social Security for their income and stuff like that. They usually have cash, that in the bank and stuff like that. But let's just say they don't have it. Is that a conventional loan would let somebody that was retired purchase a property?
Right, and we got to be careful here too, because if you're dealing with Fannie Mae and Freddie Mac, reserves aren't required.
Okay.
But if you're dealing with a jumbo loan, you're going to have reserve requirements. So if you're talking about someone that is on retirement.
And what are reserves? Explain.
Reserves are basically whatever your mortgage payment is. Some investors like to have 6 months left over in cash, some 3.
In the bank, in your savings account.
Some will allow 401ks, some will allow 50% of the 401k. So again, every investor has different rules. But as long as the income will last for more than 3 years, then you can count it. It's pretty easy to count. Social Security disability is not taxable, so you can gross that up.
Okay.
So if you make $1,000 of monthly income, we can kind of say it's $1,250 because there's no taxes being taken out. The same if you made $1,250 and had taxes taken out, you'd bring home $1,000. So it's about the same thing. The self-employed person you were talking about before, when you're self-employed, you have to worry about expenses. People say I make $100,000 a year, and when you get the tax return, they make nothing because they expense everything. So you have to be aware of what can be added back in. So when you're self-employed, you can add back in depreciation, and for salespeople like yourself, you can add back business mileage. A lot of people don't know you have 30,000 miles of business miles. You can add that back into income as well.
Very good. So, and then when somebody's coming to talk to you about a loan and their qualifications, what's better really, a 30-year or a 15-year? What do you think? Because the rates on a 15-year are pretty low.
Yes.
I mean, the rates are so low.
They're 2 7/8 right now.
Yeah.
15-year.
So, so they're really low. Is it better for me to get a 15-year loan, or should I get a 30-year mortgage? What's the better?
Well, that depends on the customer. If a lot of customers maybe that are more later more mature in their age, and they don't want to be saddled with a 30-year mortgage, and they have the income, getting a 15-year loan might be a good deal for them. If someone's wanting to max out and want to buy as much house as they can, a 30-year loan will buy them more house. As that particular, like first-time home buyers, but as the first-time home buyer's income goes up, you can turn that loan into a 15-year loan just by making extra principal payments.
So, and is there a formula to figure out the extra principal payments? Is it like one extra payment or 2 extra payments a year? Isn't there a way to figure out that it's a 15-year mortgage?
Oh yes, you just amortize it over the 15 years, figure out what the payment would be, and then you just make sure that you pay that. Paying that extra year is kind of like a bi-weekly mortgage, if you've heard of those.
Yes.
It's just making one extra payment a year, so you don't have to sign up and get special software. You just make one extra payment a year, and you're not going to think about 8 years off your payment. But talk about the loans and the different guidelines between Fannie and Freddie and buying power. A lot of people don't realize that Freddie Mac goes to 50% ratio where Fannie Mae doesn't.
Okay.
So when you're putting a nice chunk of money down and you run a Fannie Mae underwriting engine, it might say no because it's over a 45 ratio.
Okay.
You switch it to a Freddie and you get that loan approval.
Perfect. Thank you. And that ends our session today. We thank Barry for coming in and thank you for viewing. Have a good day.